Morning, everybody. 7:30 on Friday. It is Friday the 13th. I don't know if you're superstitious or not, but the way that this market is behaving, I certainly am a little bit spooked. I hope everybody's having a good start to your day. This is a 30-minute show that we're going to do to take you through everything going on across the markets. Let's just get started. I don't know why we would waste any time. Anyway, here we go. Friday the 13th. Brent closing above 100. We'll talk about all this stuff. I mean, come on. What else is going on in this world? A lot of news. A lot of news. Our rundown today, pretty simple. Bond markets, this is the real shock. This is what we got to be focusing on. That 30-year bond near 5%. Rate cuts have been pushed to December. I'm telling you, it's just not going to happen. Brent crude closing above $100 yesterday. No drilling response is coming. We'll talk about supply not being fixed. The buy the dip model is broken. However, I want to walk you through what my expectations are for today, the key levels that you need to be watching. This is a lot different. This is a tough environment. I'm going to walk you through the daisy chain domino effect world of finance this morning right now, what we need to be concerned about, because Scott Bessent said something that I found to be a little ominous. Finally, we have PCE, GDP, durable goods, a lot of other things coming up today. I'm going to break down the PCE for our Money Printer Pro folks. Let's get to it. Our chart of the day is this. This is March 12th, 2020. Look at these down moves. Apple down 12.5%, Google dropping 12.3%, Amazon 8%, Baba 8.6%. This was the height of the COVID cycle, and it was 6 years ago yesterday. And I want to point something out that I noted yesterday. I said that this chart, this was supposed to be priced in, everybody said, right? The worst of COVID, the worst of the recession, priced in February 28th, priced in March 5th. It was never priced in. And I want to just point out the reality and why it's so easy to get caught up in that narrative. It's priced in. So definitely buy that dip. The signal that we have, which is triples, we're now online. Members of Money Printer Pro get access to this, including the numbers of breakout and breakdown stocks. You can see CF Industries is on this list. This hit our list at 116. It's at 138 this morning. All these stocks breaking down. This is all part of the Money Printer Pro experience. We're going to be increasing that price soon because the value is just too good. But right now, once again, we caught this on February 21st, 2020. February 21st, 2020. We've been negative since January 28th of this year. And since then, we've seen that huge decline in gold and silver prices. We had one of the biggest momentum sell-offs in the last 6 years, happen a week later. We've had that huge downturn in South Korea. And then, of course, here we are right now with the worst momentum that we have seen since November 20th of 2025. That was the day before Japan announced stimulus. But I'm going to explain to you why there is no cavalry coming soon. Once again, signal is live. All you got to do, be a member of Money Printer Pro. Today's calendar. Core PCE, durable goods, GDP revisions. I don't care about the GDP. I care about that core PCE number. That is the Fed's preferred inflation rate. What are we looking at? And again, remember, this number is ahead of the overall expectations that will come the start of the Iranian war. It will not include any of that. So we're going to get that PCE number next month. But right now, if inflation is rising, if there are concerns about energy prices and food prices, this is going to set the tone for expectations out into December, where we've already seen the odds of a rate cut are now not even close to priced in. The JOLT report will come out today at 10 as well, plus Michigan consumer confidence. That's a big one too. This is the first major read for March. And again, combine the gas and war and how strapped and tested the U.S. consumer is. Watch for a sentiment drop. After hours, Adobe CEO is departing after 18 years. Revenue beat, stock still fell. Adobe is part of that software space that just cannot get a break. The AI threat is real. Ulta Beauty missing, beat revenue, but missing on earnings per share expectations. Stock fell. Lennar missed on EPS, missed on revenue, second straight quarterly miss. And for all the chatter about housing, with interest rates in pressure, this is going to remain a major macro story and concern moving forward, especially in the event the fact that we're still not able to build as many houses as are necessary. This is a story for 2027, 2028, but it all fits into the broader macro. This is exactly what I warned about. I said it on the backside of our report on Iran, and I've talked about this a couple of times in the last couple of weeks. The 30-year bond has hit 4.8%. It is an independent pattern, and it is a breakout risk. And the possibility of going to 5% or higher. Remember, that is the cost of long-term U.S. debt. And when that moves higher, every time we get by 5%, stocks have been beaten up on this. The 2-year yield just saw one of its biggest one-day jumps since May. That's shorter duration. The Fed is already buying $40 billion a month of 3 to 12-month treasuries to refinance this government, keep the trains running on time. But it's not good news when you start to see that 10-year continuing to creep higher. And once again, what happens when that 10-year starts to creep? That impacts collateral quality. That impacts repo financing. That increases haircuts. And the SOFR and the concerns that we talked about that yesterday. The idea of we're all hyper-focused on the Fed funds rate next week. The Fed funds rate does not have the impact that it used to. It is unsecured collateral lending. That's about $100 billion for international arbitrage between home lending banks. It doesn't matter as much anymore. What matters is the secured overnight financing rate, the SOFR. Read the article if you missed it. I wrote it yesterday explaining what it is, why it matters, why the Fed actually contains that, manages it, and doesn't tell you this. And then as we look at this, higher that 10-year goes, the bigger the cracks can be in the bond market, and that can lead to these domino effects that I've discussed. Now then, the odds of a rate cut have completely and totally fallen off of a cliff to the point that it is basically 40% for December. There is your rate cut expectation. So forgive me, 62%, 62.1%. So not fully quote unquote priced in. We want to use that term. The reality is at this moment, we were looking at 2 cuts. We were looking at March not that long ago. We were looking at June. We were looking at September. Now we're looking at nothing. Nothing. Higher energy prices, persistent inflation, all of these things continue to rattle confidence in this market. Oil's back above 100, or was last night. This is critical. It was the first time that oil prices had moved and closed above 100 since since August of 2022. I want to remind you that in August of 2022, that helped crack the financial system. That was where we had the gilt crisis 2 months later. We saw the largest single-day jump since May 2020, which is where momentum had just returned back to the market and speculation had rebounded on the backside of that negative $37 per barrel for the April contract of that year. And prices continued rising overnight. So really the key thing here is that Khamenei, the new son, the supreme leader, has said that the Strait of Hormuz should remain closed as a, quote, tool to pressure the enemy. 7 ships were struck on Thursday alone, which is insane. Iraq ports are closed. Oman has evacuated its massive oil terminal where I've been, which is a sizable area. And semi-officials, Fars news agency in Iran reporting that the Iran-backed groups could shut the crossing that controls vessel access to the Suez Canal. Okay, that's the Red Sea, right? It's the Houthis. This is amplifying. This is not getting better. And Besson coming out and saying, well, we're going to have the Navy escort. The United States Navy is not prepared to do that. They've already said that. Jeffries has said that they are not going to see U.S. oil producers start to drill just simply on short-term volatility. Exxon, Chevron, and Conoco are looking past the spike. In fact, Exxon and Chevron are likely spending their time trying to assess whether or not they're going to even stay in the Gulf region, or if they're going to commit the capital that they had previously shifted that capital toward the Gulf states. Will that be pulled back? That will be interesting to watch. Jeffrey's saying companies are, quote, unlikely to make long-duration production or capital allocation decisions based on short-term price volatility. The forward curve is telling us the story. Brent is below $70 by 2030. WTI is below 65. The market was oversupplied by about 1 to 3 million barrels per day before the war had started, and companies know this. So that's why there will not be frantic drilling just for the sake of drilling. This is really the other major trend that's kind of the underlying element, and this is a behavioral shift in the way that markets operate, and these are critical events in time. Retail has been the persistent buyer whenever there is a dip, and right now we are not seeing it. This is the first time in over a year that this is a sign of weakness, persistent sign of weakness in the retail investor behavior. Retail investors have basically been conditioned over the last, since August at least of 2024, to step in and buy the dip because, well, they just believe that you buy the dip. Every time it hits the 100-day moving average, buy the dip. Every time it hits the 50-day moving average, buy the dip. Really, at the end of the day, it was kind of a Pavlov's dog type of environment where if the markets did sell off, it was likely tied to the plumbing of the financial system. So could be a repo issue, could be tied to what was happening in Japan. We had multiple events that happened going back to August 2024 where volatility spiked and then it fell by 40% in 10 trading days. Now, to put that into perspective, 6 or 7 of these events that had never happened before September 2011, which, by the way, that was when the ECB had stepped in, European Central Bank, to provide ample quantitative support during the European banking crisis. So that was the only time that volatility fell like that in 10 trading days. It has happened 6 or 7 times since that August crash in 2024. So if you think about what changed, every dip since late 2023 got bought aggressively. October 2023, when we saw the 10-year go to about 5%. April 2024, that was during the pullback that transpired around money markets being drained. August 2024, that was the Nikkei crash. So every time the market is pulled back, retail has come in and bought, and it worked. The S&P actually made new highs every single time. They trained a generation of retail traders to believe that the dip is free money, but something has changed, and it has a lot to do with oil prices being over 100, bonds moving higher in terms of yields, and that credit tightening, which is tied both to private credit, but also to consumer credit. And these are 3 headwinds that retail can't trade against. That's very important. And that's why we're seeing the Dow under 47,000 for the first time this year. The S&P 500 has posted its 3-day biggest percentage drop in a month. And the NASDAQ is down nearly 2% yesterday, its biggest drop in a month. So when the floor of reliable buyers disappears, corrections can get deeper very quickly, and institutions struggle to find people to hold that proverbial bag. I will note, however, that when we get down into an environment where our reading basically hits 0, where there's no aggressive buying, that's kind of where sellers will take some time off trying to dump larger positions and will actually look for a little bit of a short squeeze. that they can then sell back into. That's part of what we have called the 1% pattern. We'll talk a little bit more about that later next week. Just to highlight the Money Printer Pro screener, fertilizers were on the top of the list. CF Industries having a huge 3-day move. We were at 116 when it topped our list. We're at 138 starting this morning. CF, huge day yesterday. S&P 500's top gainer for Wednesday. Mosaic on the list as of 2 days ago, 10% move. And Nutrien, NTR, we've seen Dow move on that list. This has been on for multiple days. These have been the top breakout stocks. These have been the things to trade. Now, I wanted to point this out. I talked about this on Sunday night. I did about a 40-minute presentation on Iran. And as I noted, the fertilizer side was really the thing that concerned a lot of people in my circles the most from an agricultural perspective. We don't know what this is going to look like. But that said, it is critical to note that it is going to have an impact on our agricultural state here in the United States. It is going to impact costs across the board, and this has a 6 to 12-month lag. So this is going to impact commodity prices for a foreseeable period of time. The big question and the big geopolitical risk that comes out on the other side of this is how this ultimately impacts the Middle East, Northern Africa, nations like Egypt, where food prices can and will spike very aggressively. Very high percentage of discretionary income spent on food in certain places like this around the world. We have to keep an eye on this because, as we've noted, this becomes that aftershock effect that transpires. But these stocks still leading the way, still trading, and certainly something that will be watching using either volume-weighted average price or watching key technicals, which we'll walk through in a minute. Our momentum indicator is extraordinarily weak, and I'm giving it away this week because I want to just simply note that this is a high danger environment. I did something very rare yesterday where I reached out to my postcards from the Edge of the World readers, and I just simply said, look, this is a very difficult environment. We haven't seen a reading like this since November 21st. At that time, that's where we saw Japan step in and provide monetary support. And that's significant because when we get down into these levels, that's where we start to look for insider buying to be aggressive. And we also start to look for policy responses. But the reality is there is no cavalry right now. Scott Bessent saying that we are a long way from the Fed going back to QE. Now, they're doing something similar to QE, which is the reserve asset management. That's where they're buying short-term treasury bills. But QE is we're going to buy 10-year bonds and we're going to throw it on our balance sheet and we're going to create money out of thin air, create reserves, pump it into the system, suck the bonds out, and help maintain yields across the borrowing costs across the economy. That's been the story of Japan for 20 plus years, and we're probably heading in that direction at some point. But it's important to note that as we look at this, right, this is where we sit right now with our confirmed readings. The stocks that are in real breakdown mode are financials. They're Huntington Bank shares, they're Fifth Third Bank, they're Regions Financial Corp. And this weakness is likely going to persist through at least April because that's where the banking reserves are under pressure. That's why the Fed is doing the work that it is doing. And that's why we have to be cautious trying to call any dip on financials. I will note, however, if we wanted our financials to move much, much higher, it would involve quantitative easing because every time that we engage in quantitative easing, we end up providing support to our banking system. That is because we are a financialized economy. And when China pumps money, it helps commodity prices, manufacturing, and particularly their construction industry. So this is a very dangerous area. Now, as I've noted, when I look at the SPY today, and it is a Friday, I kind of get this feeling that we kind of got the feeling we were going to squeeze today. Well, it looks like we're already getting that type of short-term pop. That is a very interesting number right there, right? 662. We're already seeing a 6-point move. I want you to be honing in on a couple of things today. First, get out a 3-minute chart. 3-minute chart, pull up the SPY, put the lines. That green line is your simple moving average, your 8-day moving average, and that orange line is your 20. So this is a 3-minute chart, which means your green line is 24 minutes. Your orange line is 60 minutes. When this green line starts to move under that 20-day, that's where we can potentially see selling. This is the technical traders looking to take advantage of overreaction, too much of a squeeze. On volume weighted average price, you have that open, you do the same thing. You look and you see, if you see that squeeze happening and you see that rollover right here, right? And that aligns with a deviation line. And we're currently at the top of the first standard deviation right here. That's where you can look to fade this market. Now, if we sell off today, because our trend is very, very clear, lower highs, lower lows, a squeeze is not outside the realm of this market, particularly with the lack of buying in other sectors. It is a Friday. There are a lot of options. It's why you want to keep volume weighted average price open. It's why you don't want to short unless you have some sort of confirmation to do so. And even then, you want to keep your stops tight. That VWAP right here, down here, this is where we look for reversions. The trend of this market is clear. It's lower highs, lower lows. It's very evident on the 30. And I kind of anticipate that our next move is going to be to the downside, obviously, but a test somewhere up around the 670 level before we get there, 674 maybe, even. You can see, you can literally visualize it. Just taking a step back, look at the daily, look at the hourly, lower highs, lower lows, channel-based trading. And the next move, probably somewhere around 659, 658 before that next little pop up. Trade those ranges. Very important. All right, I want to just get to this real quick, and I got a little bit of content that I need to pull up real quick just so that I make sure that I articulate this correctly. Article that I'll write over the weekend is called How a Snowflake Starts an Avalanche. And what we're focusing on right here is what is known as a domino effect. And that's what happens when a problem in one part of the financial system triggers a problem in another part, which triggers a problem in another part, which then leads to something else that nobody saw. And then somebody turns around and says, nobody saw this full-blown crisis happening. We are in an environment right now where we have three daisy chains all lined up at once, or domino effects, or however you want to define it. I want to go back to September 2022. And the reason for that is that was the last time oil was at 100. That was August 2022. In September 2022, the new Prime Minister, Liz Truss, had announced a mini budget that included unfunded tax cuts. The gilt market, which is where U.S. government bonds trade, did not like that, and yields spiked 100 basis points in 4 days. The spike in those yields was the first domino that happened, and it immediately knocked over the second one, which was something almost no one outside the pension industry had seen at the time. Pension funds had been using a strategy called quote-unquote liability-driven investing, where they used leverage and derivatives tied to government bond yields to match their long-term obligations. It was considered conservative and safe, and the whole point was to reduce risk. But it was leveraged, and when gilt yields spiked, the LDI strategies faced massive margin calls that required pension funds to post billions of pounds in collateral they did not have readily available. So what did they have to do? They had to sell gilts, treasury bonds, in order to raise cash. And the same government bonds whose falling price had caused the margin calls in the first place. That drove yields higher, which triggered more margin calls, which forced more selling. And within 5 days, the Bank of England, which was supposed to be tightening policy to fight inflation, had to reverse course entirely and launch an emergency bond purchases of 10 billion pounds per day. A central bank that was raising rates on Monday was printing money on Friday. And Besant has said, we are not doing QE. We are a long way away from that. Well, let me tell you, sir, you got three dominoes coming all at the same time. And if any of this starts to go, the Fed is going to have a very hard time containing one of them, let alone three of them. The oil chain is pretty simple. The Hormuz shuts. That leads to a spike in the secured overnight financing rate. And by the way, we are practically there. It happened last week. This can break the $1 trillion basis trade. That's where hedge funds lever up treasury bonds in order to generate literally like 5 to 15%, right? But it creates artificial demand for US debt. Okay. If they sell all those treasuries, yields go up. This was an issue in 2022, 2023, 2020, 2008. Now you've got $875 billion in refinancing at the commercial real estate level that needs to be done at higher rates than where we were back during COVID. They can't refinance because the banks may have to pull back, and then the consumer starts to tighten, and now you're in trouble. That's the first chain. The second chain is, well, actually more realistic. This starts on the other side of the world where the Japanese 10-year bond yield has surged to an 18-year high, and the Bank of Japan is signaling further rate hikes. And we have the Bank of Japan meeting next week. An estimated $350 to $500 billion in that carry trade remains outstanding after only half unwound during that 2024 scare, which crashed the Nikkei by 12%. So the Bank of Japan hikes, the value of the yen surges, the carry trade unwinds. Well, that carry trade is heavy in AI stocks, S&P 500 leaders. That can lead to a drastic downturn in the U.S. equity markets, as happened during August 2024. Look at what happened on August 5th of that year. By the way, our signal had gone negative on August 1st of that year. So we were out of the way. Why does this matter? When the yen strengthens, it forces simultaneous liquidation of almost every asset class that the carry trade touches, and selling pressure hits U.S. equities first because the AI mega caps that account for 30% of the S&P 500, that was the estimate at the time, are the most liquid things to sell. People have to sell. Spreads start to blow out, and then, credit could freeze as a result because it could freeze the corporate bond market and freeze the high yield market. And at that point, the private credit funds that were already under pressure from the oil chain cannot refinance their positions either, and gating becomes widespread. The third one is the credit chain, and that is the one that has kind of kept me up at night. This one starts quietly, and it doesn't need oil or the yen to get going. Private credit has grown 12x since 2008 to $3.5 trillion, largely unregulated and without leverage caps or public disclosure mandates. BlackRock, Blackstone, and Cliffwater have gated already on major funds. And when an interval fund gates, it sends a message to every other investor in every similar fund that their money might be locked up to. So they gate that. And that can lead to forced selling at a discount, as Boaz Weinstein stepping in and offering 65 cents on the dollar. What can then happen is widespread markdowns. Rush to the exits leads to a number of things. Performing loans get marked down because there are no buyers at par. And when other funds hold similar assets, they're forced to mark their own books lower. Their investors see markdowns. Now, some people are going to criticize that and say, whoa, that stuff's at par. That stuff's been marked down. But the reality is, if we go through these books, I'm starting to see things that clearly, people were saying, well, in 2008, the loans were bad. This underwriting process looks pretty bad. And these numbers universally, I asked somebody the other day, what percentage of these loans marked at par are inaccurate? They're not actually valued what they're said. And the person said 100%. 100%. Because, and again, it's not everything's 20% over. It's like, it's, pennies on certain that, but that was a jarring statement. And it's not just the software spot. It's not just the AI spot. It's the energy world, right? That energy assets aren't necessarily worth what people are being told that they are. And a lot of this stuff originated offshore. So you've got these three different chains. And the Fed, if one chain fires, the Fed can probably contain it because that's exactly what the standing repo facility is for. The emergency lending playbook is designed for this, but if two chains fire at the same time, containment becomes difficult. And if all three hit at once, there's your avalanche. It doesn't take much to cause these problems. And the thing about avalanches is that nobody blames the snowflake, they blame the mountain. I'm not saying all of this is going to happen, but I'm telling you right now, you have to be paying attention to every single one of these things on this screen. We are here on the oil chain. We are here on the yen chain. And we are here on the credit chain. Just pay attention. Fed meetings next week. SOFR is in focus. Bank of Japan, possibility of a rate hike next week. And this is not going away. Now the question is, do we get into an environment where the markdowns start to spread? That's the big question. For right now, doesn't seem like it. But if it gets bad, more redemptions trigger, the spiral accelerates, and then you have a parallel very comparable to Bear Stearns. Hey, it's Friday. Cheer up. It's 8:01. Manage your risk. Look, we're over at Me and the Money Printer on Substack. We talk liquidity, the Fed, what's really driving markets. I promise you that today my article is going to be extremely upbeat. It's only about good news. It's all I'm doing. I know there's a lot of bad news out there. This is only going to be about good news. Postcards from the Edge of the World comes out this weekend as well. We're talking about major choke points in the global economy. I did send a note yesterday to my team, and I said, look, we're up 8.4% since the inception of this portfolio, 10 percentage points. And again, this thing works. It's a good strategy for uncertainty. But I'm going to just simply note that in this environment, everything is at risk. We are in an extremely negative momentum environment. And I'm perfectly calm, dude. It's perfect. We're all perfectly calm because we see this, we manage it, we know what we're looking for. We see the threats on the table. We've recommended cash. People are asking where to put cash. 95% of risk assets are above their trend lines. Those opportunities are going to come. You just have to be a little bit patient. Oh, and by the way, while you're doing this, it looks like the US dollar is going to continue its move higher as people continue to run toward the dollar because it is the global refinancing mechanism. Very critical. Dollar's going to have a pretty good year, despite what people think. When liquidity tightens, the US dollar strengthens because the dollar is what people need to refinance or to pay off debt. So there is competition for it, which paradoxically inflates demand. InsiderStockBuys.com is live, everybody. And if you haven't checked it out, please do. That will be up and running relatively soon. We also have the Insider Buying Report at Substack as well. Today, we put out our report later in the day, likely with the trade around coal. I hope everybody has a great day. I got to run this out the door right now. We went a little long, but you have any questions? Just hit reply, man. It's not that complicated. I hope you guys have a great weekend. We will catch up on the other side. Stay positive.